That's a great question and very topical. In fact, it's probably one of the most frequently asked questions we have with our clients, particularly the last couple of years. The most important thing I'd say before we start is to remember that Asia Pacific is not one market, in that it is incredibly dynamic, and the factors in each market are quite different. That being said, what we see is we have three observations that I think are quite relevant for anyone participating in the Asia Pacific market. First, that the market remains strong and shows no sign of slowing down. Secondly, despite that, we do see a number of new challenges that are emerging in the market and that are going to require funds to adapt to. And thirdly, we're seeing a few common themes around what the best funds are doing to think about the challenges over the next 3 to 5 years. So let me just talk about each of those briefly. The first one on the market. As we look at the market, we think about money going into the market, so investments being made, as well as exits and returns being delivered to LPs. On the investments being made, Bain's analysis shows that in the first half of 2017, $70 billion was invested in Asia Pacific. That's versus $92 billion that was invested in all of 2016. So at that first half pace, we're on track for a record year in Asia Pacific. That's all the more remarkable when you think about what's happening with the geopolitical environment, when you think about some of the very large markets in Asia, like China, that are slowing down in growth, as well as the very high multiples that are being paid. So what we're seeing is, in fact, the private equity market growing against its own fundamentals and decoupling a little bit from the more macro environment, which we think is a positive thing. In terms of returns, private equity as an asset class has started to deliver very strong returns in the region. In fact, in a survey that we did at the beginning of the year with limited partners, 90% of LPs have stated that the returns that they're receiving are either at or above expectations. And similarly, 90% expect to invest the same or more into the region, into private equity. So we think that's a strong endorsement of the performance in the market. So that's number one, strong fundamentals and growth. Number two, though, despite that, and in fact, probably because of that in a way, we're seeing a number of challenges in the market. First and foremost is competition. So traditional GPs are facing increased competition from many new sources, whether that's sovereign wealth funds, whether that's corporates, particularly internet-related corporates in China, or whether it's new local GPs that are emerging. And that has had implications, obviously, on pricing, as valuations have gone up quite dramatically. But it's also had a few other implications. The ability to source proprietary deals has gotten much, much tougher. And so many more deals are run through formal processes. The ability to add value has become even more important to your portfolio companies because of the prices that are required to be paid. And the ability to win those deals is also has gotten tougher given all the competition. So those are some of the challenges that we see in the marketplace. That leads me to my third and most important point, which is what do we think funds need to do about that? And we're seeing really three broad themes around what funds are doing, best funds are doing to address those challenges. First, they're getting much sharper on their diligence, sharpening their deal thesis, becoming a little bit more creative and holistic on how they do diligence. Secondly, they are getting more creative on expanding their networks to source deals, trying to get ahead of public auctions, trying to find the next deal before it gets to market. And if it gets to market, using their networks to develop some sort of advantage to win those deals. And then lastly, they're getting more creative on value creation and finding the right balance between a repeatable model on how to add value in portfolio companies and balancing that against the unique requirements of an individual company or an individual market. Interestingly, what we're seeing is some of the top performing funds are the ones that are taking the lead on making these changes. And they recognize that standing still is not an option, and that what led to success in the past, while still going to be very important in the future, is going to require adjustments to their model going forward. And we think that's something that all investors need to be thinking about over the next few years.